PPI today came in slightly better than expected, but that's not why markets rallied today. In fact, markets rallied off of bad news. A 30-year bond auction came in 34 basis points higher than the previous auction. Markets took a small step down initially, and then were off to the races throughout the rest of the day. That was a little bit concerning. I was a little concerned when I seen this, but tomorrow is actually the big day. In fact, you actually seen about $2.1 billion of sell orders enter the markets in the last 10 minutes of trading. This is known as the MOC imbalance, market on close imbalance, and it was heavily skewed towards the sell side. I want to warn you that this kind of activity, bad news being good news for the markets, and a lot of sell orders heading into the end of the day before tomorrow, which could be a huge event, it doesn't sound good. Now, markets could continue to roar higher, and maybe there's no harm, no foul, but I will go over exactly what you need to know heading into tomorrow and why tomorrow could be a turning point for the markets. Before we get into all of that money-making information, hit the like button, subscribe to the channel, let me know what you think down below in the comment section. I will go over specifically what could happen with Tesla and take a look at Tesla stock on the charts. Now, tomorrow could very well prove to be the most important day so far in 2024. And you might say, well, why is that? We don't have any big economic data coming out. Sure, we have the Michigan Consumer Sentiment Survey coming out. Current conditions could be important. 1 year, 5-year inflation expectations could be important. But it's not that. Let me ask you a question. Throughout all of the bad news we have seen in 2024, why have stocks continued to do well? By stocks, I mean really the S&P and the NASDAQ on the headline. You're 1.5%, a little bit less than that, off of all-time highs. You've seen very little downside action in the markets. Now, of course, Tesla, interest rate sensitive names, small caps, other, mid-cap names have not done well, but the broader markets have been doing well. And if you ask someone on Wall Street, they're going to say, yeah, 2024 has been great so far if you're benchmarked to the S&P. There's one answer to why the markets have done well. It is because current expectations are on Wall Street that consumers are going to continue to spend money. They're employed after all. And that's going to drive earnings growth in the S&P 500. And there's an interesting dynamic going on here because we started off 2024 with the expectation of 11% EPS growth for this year. Those estimates have fallen 6%. They've fallen to 5% EPS growth. So that's not great. But markets really haven't reacted to it too much because that's common. Whenever you start a new year, estimates are really high. And then as you get through Q1 earnings, you get to Q2 earnings, you start to see estimates come back down to reality. But the generalized thinking is on Wall Street, people are going to spend money. Company earnings are going to come in good. Even if it's not 11%, 5%, hey, that's still positive. And if we think about everything that's happened so far in 2024, you're really not set up in a great way. You've had inflation come in, really hot, so we're not getting cuts anytime soon. That puts pressure on valuations. Like your risk-free return on your 10-year treasury is sitting over 4.5% right now. It has been breaking out to the upside. Markets really haven't cared too much because earnings are expected to grow and do well. But the 10-year treasury yield has basically been vertical. You're now at 4.58%. So when I think about tomorrow, you don't have a 10-year treasury yield that is falling as support for the markets. You don't have the Fed that is about to cut rates. That's not supporting the markets. Inflation continuing to ramp higher. That's not supporting the markets. The only bull case there is left, the only bull case, is earnings are going to come in good because the consumer is going to continue to spend money. And why tomorrow will be so important is because that theory could be challenged coming tomorrow. And it has to do with what the banks say about deposits, about average, amounts in bank accounts, people's spending activity. That's going to be a highlight of all of these banks that we get tomorrow. You will have JP Morgan, the most important, biggest bank of them all, Wells Fargo, BlackRock, Citi, Progressive, and State Street, with an obvious focus on JP Morgan, Wells Fargo, and Citi. That's going to capture basically the entire US consumer. In those three banks, you'll have a very good understanding of how consumers are spending their money. And this is the first sign of consumer activity heading into an earnings season with already very high expectations. Now, why I think this is such a dangerous moment also is because if you think about other earnings seasons, yes, earnings are always a huge event for the markets every 3 months, every time we get earnings. But a lot of the time, there's other bull theses, right? There can be, the Fed is getting ready to cut, economic data has been coming out, really good, really bad, whatever the narrative is. But it's pretty seldom that the bull thesis has gotten ripped apart heading into earnings. Like literally the last reason there is to be bullish right now is earnings coming in good. You can't say the 10-year treasury yield has been falling, that is valuation support, thus maybe earnings don't need to come in that good to justify valuations. Like it all hinges, the whole market hinges on earnings. Now, I think it's also important to point out that this will be on a stock-by-stock basis also, right? If Microsoft has really bad earnings, the stock's probably going to fall. I think that would be a safe assumption. If Tesla has really good earnings, the stock's probably going to rise. It is about expectations, though, so markets are always forward-looking, so guidance is the most important thing when it comes to earnings. That's what drives a stock higher or lower. I think for certain stocks or certain areas, you're better priced for downside. Think about the areas that have not done well in 2024, like Tesla, small caps, mid caps. They're better priced for bad news, for bad earnings, believe that or not, because they've already fallen so much. Some of your, large tech areas of our markets could be a little bit more vulnerable just on, this logic, but it is going to be on a stock by stock basis. But tomorrow could really change the tone around the consumer and around corporate earnings. If the banks say people are slowing down, then that's just translating here, saying maybe company earnings are also going to slow down. And based on that expectation, it wouldn't surprise me if stocks did sell off heading into their individual earnings, which big tech mainly reports not next week, but the week after that. Alongside Tesla on April 23rd, I believe you get Google on the same day. You get a couple big names that same week that Tesla reports earnings. So tomorrow could really be an event that sets you up for a pretty rough next week also. Now, there's a chance that banks come out and say people are spending money still. They're still going on shopping sprees and, running down bank accounts. And that will be all fine and dandy, but there is a chance that they have bad things to say about the consumer. And if they have bad things to say about the consumer, that's really bad news for the markets in this market environment. Normally, I would say bank earnings really don't matter to the broader markets because then again, banks don't bring in that much of the S&P 500's total EPS for any given year. Most of it comes down to big tech. But when the only bull thesis is people are going to spend money and that's going to drive EPS growth for the S&P 500, I think you're in a very vulnerable position if you get bad news around the state of the consumer from the one area of the markets that can definitively tell you how the consumer is doing, which are the banks. Now, to make matters even worse, we do have that baby mama drama with Iran and Israel in the Middle East, and whether or not that evolves into a larger conflict has direct implications for oil markets, which has implications for inflation, and that is a pretty slippery slope. So that's another bit of information that's kind of working in the background that the markets may or may not react to depending on what happens, and that's also something to keep your eyes on. Now, here on the day today, it's actually pretty interesting. I talked about the 20-day moving average in regards to Tesla stock earlier, and I will again in this video when we go over the charts for Tesla, but take notice of what happened to the S&P, right? Over, the past couple of months, the 20-day moving average was really that level in which the S&P bounced at pretty much every single time. This goes back to your, November 2023 breakout of the S&P. Basically, every time you got to this 20-day moving average, you bounced higher. What's happened recently is you fell under this level. Yesterday was the first day you closed under the 20-day moving average. Now today as well you did. Even though you did see a 0.75% rally in the S&P, you still closed under your 20-day moving average. The S&P closed, the SPY closed at $518 flat. And here in after hours, the S&P is up 0.01%, up 5 cents to $518.05. Your 20-day moving average is at $518.13 per share. Now you're very close. I wouldn't draw any definitive conclusions here. If you move higher tomorrow, that's great news, right? Maybe the 20-day moving average after all held support. Maybe that means markets can continue to trend higher. If you don't, if you fall tomorrow, depending on what the banks say, it could have a little bit more of a meaningful impact for the S&P, at least based on the technicals, because that would mean, let's say tomorrow does fall, that means yesterday you closed under the 20-day moving average. That means today you found resistance at the 20-day moving average. And then let's say tomorrow you fall. Maybe that's confirming that you're struggling at the bare minimum to get above that 20-day moving average, which again can lead to more downside. But let me be honest with you. I have no idea what the banks are going to say. I have no clue. I just know we are at a very vulnerable position in regards to the bull thesis for stocks, because you've rallied a lot. You've seen a lot of things crumble. The bull thesis has basically crumbled in front of your eyes for 2024, besides the consumer. And if we get bad news from the consumer, and that's what the banks tell us, well, I don't see any reason why stocks should be trading at 21 times forward 12-month earnings. Yeah, that's the current valuation on the S&P, with the SPY trading at 515. With the SPY trading at 518, it's going to be a little bit higher than that, right? So maybe like 21.3 times 12-month forward EPS. That's expensive. That's really expensive when a 10-year treasury bond is paying you almost 4.6%. It's not the most opportune moment to be buying stocks. Unless earnings come in really good, then maybe markets are at a fair value at this point. Now, I think as we get deeper into earnings, I think markets have priced in so much good news that you're going to have to see some big beats on earnings to justify where a lot of these stocks are at. So later on over the next couple of weeks, that's also something to be watching for. But again, I do think this will be on a stock by stock basis once you actually get down to earnings. And to be honest, if we do see a sell-off tomorrow or next week, that sets you up in a better position for big tech earnings, for earnings season in general. If you stay at these elevated levels on the S&P and the NASDAQ heading into earnings, you're probably set up for ultimate disaster no matter what the earnings are. But let's say you sell off 2 to 3% from now until big tech earnings, call it around April 23rd for Tesla. Maybe you're set up then in a more optimal position. I'm not sure, but I think it's going to be on a stock by stock basis. For that matter, Tesla stock looks very attractive right now. I think for any fund manager that needs to stay invested in the markets, Tesla is at a moment in time in which you've seen estimates come down a lot. The bar is very low for Tesla. If Tesla gives you good news, the stock is going to rally on earnings. And I think even if the markets are falling, Tesla stock can likely still rally. As far as the charts are concerned, I pointed out the 20-day moving average in the video earlier today. The last 3 days you held support above this. That's a great sign. You have a lot of resistance from here to $200. You have the 178 level. You have the 182 level. You have the 188 level, as well as the $200 resistance. So there's a lot of resistance just go up another $25 or so. But if you break out past that, you're going to be getting to the point where I think a lot of retail investors, a lot of big money capitulated, and maybe they're like, hey, we should FOMO back into the stock, because who knows what Tesla says on earnings, but I'm sure it's going to be better than not. I'm sure it's going to have a positive effect on the stock, and I wouldn't be surprised to see more FOMO activity head into the name. Now, the RSI currently is at 48.48, which 50 is technically the neutral number, right? Anything over 70 is considered overbought. Anything under 30 is considered oversold. I like to think 45 to 55 is pretty neutral, just a neutral range. So Tesla's neutral, but slightly negative still, even after you have bounced about $14 from the 160 low. And from what I can see right now on Tesla stock, you are in this demand zone. This appears to be a demand zone as low as 160 and as high as the 185 level. And if you can get out above that, then you get, like I said, into that FOMO type level where you're out of the demand or supply zone and you're heading into a new level in which new supply can either come in, drive the stock higher. It's going to depend on what Tesla earnings are and what Tesla says, or you get rejected at your last resistance level, which would be about 188 or so. Now, I think the next couple of days could be interesting. I wouldn't be surprised if Tesla stock sold off if the broader markets sell off. That wouldn't surprise me. That's typically what happens. But just be very careful heading into Tesla earnings, specifically being super bearish, because you're more than likely set up for an upside surprise. You do have the short position as well in Tesla at multi-year highs, 3.89% short interest of free float, $18.5 billion currently sold short, and about 107.58 million shares also sold short. You can see today, even though Tesla stock was up over 1.5%, cost to borrow fees were 8.6%, suggesting there was even a lot of shorting activity taking place today. And I think shorts are biting off a little bit more than they can chew with this whole narrative that Tesla is going to continue to fall. And odds are, I think that is an incorrect way of thinking about Tesla right now. Of course, could Tesla fall from now until earnings? Yes. Pretty dang confident, though, after earnings, we're going to be having a much different conversation. After all, that would be a statistical anomaly if Tesla falls 5 earnings in a row over 9%. 5 earnings in a row. I've never heard of that before, especially not on a company the size of Tesla. Now, if we take a look at the option activity from hedge funds and institutions today, you had 688 orders in Tesla stock, totaling $1 billion with a positive order value of 53%. So I would categorize this as slightly positive, but overall a pretty neutral day. 56 minutes ago, it was announced that the U.S. is sending its top general to Israel amid fears of Iran strikes, according to the New York Times. Total money market funds fell about $31 billion to $6.08 trillion for the week ending April 10th, continuing this little trend we have of money leaving money market funds. But considering the recent rise in 10-year treasury yields, a lot of that money could just get sucked right back in. So now that you have a better understanding of why tomorrow is so important for broader markets and what's going on with Tesla, let me know what you think down below in the comment section. Do you think you are set up for downside here in the markets and Tesla, or do you think markets will continue higher? Let me know your opinions down below in the comment section. In the meantime, as you exit this video, hit the like button, subscribe to the channel. It's free 99. It costs you absolutely nothing to do so. If you guys want to come trade with us live in real time, I did make a trade on the banks coming tomorrow morning for their earnings. And if you want to see that, check out that link down below in the description of this video. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.